Let's move on to something I do get excited about. Well, not really. I mean, I do, but I don't eat them, but I love them. I'm talking about donuts.
Donuts are always good. I mean, they're a nice treat every once in a while.
Yeah, if I ate donuts, I'd probably be 250 pounds. So I avoid them. But boy, when they're around, like, oh, I'm going to grab one. Let's look at Krispy Kreme donuts. That's what we're talking about. Their symbol, that's why I say it, is DNUT, do not, donut. So in the grocery stores, I guess they're considered a grocery store business. Wow. Here's something amazing. The short on the float side is 25.4%. This stock is sitting on a lot of short shares. Only 54% institutional owned, means a lot of individuals bought this stock. No PE ratio because of no earnings. Price of sales, 0.3. That is still higher than the industry at 0.2. Price to book value, 0.5 versus 2.9, but there is no price to tangible book value. Again, intangibles would wipe out any value here. Price to cash flow, 12.8 versus well over 500 for the industry. No PEG ratio. We do see earnings of last year, no earnings of last year. Sales over last year are down 6.5%. The industry was actually up 1.3%. I wonder who these analysts are. That's one thing we can't find because a 5-year earnings per share growth rate for the analysts, 26%. I mean, are they not seeing what's going on? And maybe people love Krispy Kreme donuts.
Or it's coming from such a low base. I mean, you go from negative earnings even to slightly positive, you could have good growth.
Could be a math anomaly, I guess. Yeah. So they do pay a 4.4% dividend, which I think that's not going to last much longer. No payout ratio because they have no earnings. We do see that on the balance sheet. Let's see if they got a good balance sheet. Here's another one. Current ratio, 0.4 versus 1. And we don't like a current ratio much below 1. That means you can actually pay your next 12 months of liabilities or 12 months of assets. 0.4 means you can pay maybe your next, 3 to 4 months. That's not a good position to be in. And their debt to equity is also kind of high, 1.3 versus 1.6. Net profit margin, well, negative 1.4%. They lose about 1.5% for every donut that they sell. Return on equity negative 2. Free cash flows a negative $75 million. I'm going to say maybe eat the donuts if you like them, but don't eat the stock.
Yeah, I mean,
unless you guys are different.
It's not looking good for Krispy Kreme, unfortunately. Their current price, $3.17. 52-week range, the low here's $2.58. The high, $12.68. Year to date, I mean, the stock has just been hammered down 68%. And it looks like the stock came public again. I believe they were public years ago. They went private or went bankrupt. I'm not sure what happened, but they definitely disappeared off the stock exchange. Reemerged in 2021. The chart I'm looking at was around like $21 a share. It looks like kind of its peak, but since then it's just down, obviously, to go from 21 to 317 is definitely a problem. But going forward, I go out here to, it looks like they do report on a calendar year, so December 2026, just 2 cents in terms of the estimated earnings per share gives you a target sale of 33 cents. I mean, this company's having issues, and the big problem that came about, it caused the stock to fall about 25% last week, was they were actually reassessing the rollout they had with McDonald's, where they were going to be in all McDonald's locations. Looks like that wasn't really a profitable endeavor for them. Actually, management did say that they're slowing down that rollout for profit reasons. They had to really kind of ramp up that supply. And when they were doing so, they expanded capacity quickly, which then weighed in profits, caused 3 quarters of net losses. So that's maybe why earnings are expected to increase, not positively, but because they got so bad that they're trying to get back to a more normalized rate. And it looks like this McDonald's rollout was maybe too fast for them, and they should have taken a more measured approach. And now they're pulling that back, which will hurt sales growth, but maybe in the sake of saving profits. They also did pull guidance as well, which generally investors don't like to see. So I'm not liking it.
I'm pretty sure, well, your memory is better than mine. But I think when this happened, this deal with McDonald's, I think we talked about it and said, wait a minute, how are you going to share the profits with McDonald's? I think McDonald's probably took too much of the pie.
Sure.
And therefore, Krispy Kreme's had like no profits there, and it was expensive for them. And we talked about that before, like this deal just doesn't make sense to us. And sure enough, if you said, no, you're wrong, you bought the stock, you're not doing well.
No, it's definitely been hammered quite hard.
And that's why we look at things so closely to understand. And don't just get excited about what's going on. Look at the numbers. So